Let's first start off with what are our perspectives when it comes to what we expect from the economy in the current financial year. I think when we started the year, it was just about the time when we had lockdown, and we were quite optimistic in the sense that it was felt that India would be one of the better performing economies along with China. That was in the beginning of April. So I remember the United Nations had put out a report where they had spoken about a positive growth rate being registered by India and China. And subsequently, we had seen that the IMF had also felt that India would probably be slipping in terms of growth, but it would still be better than those of other countries. And subsequently, as the lockdown started off, and we had different phases of the lockdown, which carried on right into May, and then partial opening up, which we started off from June onwards. I think the perspectives have changed. We've seen estimates moving towards the minus 10 to 15% range. And finally, we at Care Ratings came up with a number of minus 7.7 to 7.9%, and felt kind of vindicated when the RBI also came up with a number of minus 7.5%. And I think that's what even the Central Statistical Organization is talking of. Well, these numbers per se are not that significant, since we all know that we're having for the first time a negative growth in GDP. What does this really mean for us? Actually means that the first time the economy is shrinking, and with the exception of agriculture, all other segments are supposed to be registering negative growth rates. But this automatically means that our production has gotten affected. In particular, if we're looking at the SME segment, which was possibly the worst hit segment, hasn't quite recovered. And in the current financial year, we've seen that, notwithstanding the fact that several measures have been taken in terms of restructuring of loans, making credit available under the emergency credit line, with the guarantee being provided by the government of India, I think there are serious problems which are there on the demand side. So, given the fact that the SMEs do have a very important role to play, not just from the point of view of overall growth, share in manufacturing as well as services, but also in terms of exports, I think this is one particular segment which is vulnerable, has always been vulnerable. And I think this is the focus sector which we'll have to focus on, because a related issue, which I think is a major problem for us today, is employment. That gets linked with the SME sector. I think that's the crux of the issue, that today in the economy, we have two engines which are not firing. One is consumption, one is investment. And if we're talking of consumption, there was some feeling that there would be a revival in the months of September, October, November, and probably even December, as we end the festival season and the post-harvest time. And we have gotten a kind of a mixed baggage out here. While certain months have shown that there has been an increase in demand for consumer durable goods, including your automobiles, a bit of real estate and housing. But on the whole, we have seen the numbers have been fairly volatile. And the sense which we are getting is that, well, yes, definitely on a month-on-month basis, the economy is doing better, because as we're unlocking the economy, there would be a tendency for production to increase relative to what it was in the previous months. But if we're doing a year-on-year comparison, the picture is still quite dismal. And it will probably take another year or so before we're able to return to the so-called pre-COVID levels. Even the pre-COVID levels, I think I would like to flag the fact that we ended 2019-20 on a rather negative note, because we had growth of just around 4.2%, again, one of the lowest numbers. And we had all started off with estimates around 7.5 to 8% for 1920. So notwithstanding the fact that the lockdown was in motion for the last 1 week of the financial year, we still came down with a disappointing number. It was back to saying that, why is it that our consumption has not been growing? Why is it that investment has not been growing? Because there's an extent to which we can rely on the government to propel the economy, but otherwise it'll have to come more from the private sector. It'll have to come more from these two particular engines. Now, I mentioned out here, I think the problem which we have here is of employment. So not enough jobs have been created in the past. And what we have seen is that during these pandemic times, there has been a tendency for corporate India especially to start cutting down on the salary bill. There's been a tendency for layoffs in a number of sectors, especially if you're looking at the services sector. So within the services, if you look at hospitality, you look at tourism, you look at media, entertainment, I think these are the segments which still remain largely closed even today. So while there has been some kind of a semblance of opening up in certain pockets, given the fact that our migrant problem has not yet been addressed fully, people have not started coming back to the place of work because of the uncertainty which lies. I think what we have seen is that the service sector, which used to be the driving factor of the Indian economy, given the fact around 60 to 65% of our GDP comes from this particular segment. I think seeing the services sector collapsing in this particular year, I think that is one of the major things which we should keep in mind. So all this has meant that if jobs are not created, incomes are not increasing, I think that has affected consumption. Maybe to a certain extent, there was some kind of pickup which took place in the months of October, November. But if you look at your IIP growth numbers, I think it's positive one month, negative next month, just at a point of time when we thought that we've at least moved into the positive territory. We've been told that in November, the number was actually again negative. I think consumption is one problem which we have. The second is in terms of investment. I think for any economy to grow at 7 to 8% on a sustained basis, we need to have investment increasing. And what we have seen in India is that, again, there are two sides to this. One is what happens in manufacturing, the other what happens in infrastructure. In terms of manufacturing, we have seen on account of the lockdown, on account of the fact that people were not allowed to buy their the regular kind of goods which they would like to do, we have seen that there is surplus capacity in most industries. So based on RBI data, which we have for June, it was around 47%. Our sense is that even in the quarter ending September, it might have improved to probably the early 60s. But typically, we need to have a capacity utilization rate in the region of around 78 to 80% before we are in a position to say that there's a fresh investment going to come up. So this doesn't mean that investment is not taking place, but CMI data shows that investment is definitely around 30 to 40% less than what it was last year. It is taking place in certain industries, but it's more localized rather than being broad-based. And what we really require is that broad-based investment to come. And given the fact that we're not really expecting positive growth in the industrial sector for this current financial year, it's back to saying that it could be happening in the next financial year, probably because of the low base effect. The other part is on infrastructure. And in infrastructure, we have seen that private sector infrastructure has again been lagging, because normally it is a case of saying that the government takes the initiative and then it is followed by private sector investment. But today we have a situation where while the central government has been trying quite frantically to meet their expenditure targets, but the state governments, which contribute to a comparable amount to what the states central is really putting in, have had problems in terms of balancing the budgets, managing their fiscal deficits. But consequently, we have seen that investment, even from the government side, has been lagging. And given the fact that most of the states, as well as even probably the central government, are going to be overshooting the budget, their fiscal deficit numbers. Central government was targeted 3.5%. We believe it could be closer towards the 8% mark. We have a number of 7.8 to 8.4%. State deficits are probably going to be in the region of around 4%. The only way you manage it is by cutting down on your discretionary expenditure, and discretionary expenditure automatically translates to capex. So we are really talking of an entire cycle which has been lost in this particular financial year on both investment as well as consumption. Consumption, of course, has been a continuous story, because earlier we used to always say that consumption is suffering because of a drought year, farm sector not doing well. But for the last 3 successive years, we've seen that agriculture has been a rising star, so as to say it, within the composition of our GDP. But notwithstanding this particular factor, we have still seen that consumption is not quite so that is the picture as far as we're talking of last year. And two particular things which we would be looking forward to, I think, in the next month or so. One would be the union budget, and the second would be the monetary policy of the Reserve Bank of India. Now, as far as the budget is concerned, I would like to say that we should temper our expectations, because if we're looking at what really is a budget is a statement of account. It's a kind of a P&L account of the government of India, just like you're talking of a corporate P&L. And there are lots of limitations to what you can do, and everything is contingent on what happens in the economy. So when we're talking of the ability of a budget to propel the economy, I think there's not too much of elbow room which is there for the finance minister. I think that's one of the reasons what we have seen the government being very, very proactive right from the month of March, where we had these Atmanirbhar programs which were launched, which had which had lots of programs which were mentioned over a period of around 7 to 8 months, right from May to November, where they tried to address issues in different sectors. And at that particular point of time, I think there's been some bit of controversy about whether it was really a stimulus, a fiscal stimulus, or was it a monetary stimulus. But the way I would tend to look at it is that it was a kind of an overall reform package, policy package, which the government had brought in different steps, in different stages to cover different sectors. And I think wherever there were pain points, they were trying to address it. And most of these measures, I would tend to believe, are more for the medium to long term. They were not supposed to be some things which were to work miracles in the current financial year itself. Again, if you look at something like the PLI scheme, I think that is something which has been spoken of, a very effective scheme. But we should remember that it's based on certain targets being met in terms of both investment as well as in terms of turnover. And that's not something which can happen in a single year or even maybe in 2 years' time. So the way I look at most of the Atmanirbhar announcements made is that they were targeted towards the medium term, so that over the period of the next maybe 3 to 4 years, sector-specific problems that you've had in real estate sector, maybe in your infrastructure, covering the power sector, looking at roads, those kind of things have actually been addressed. So if we're coming back to the budget to say what can really be happening in the budget, we should remember that the primary goal of the government this year is going to be some semblance of fiscal consolidation. Things have gone quite horribly wrong, I think, this year. Because if I'm saying 3.5% going to something like 8%, the main goal of the finance minister will be that how do we charter a path so that we're able to go back towards the 3% number. Admittedly, I don't think one can do it in a single year's time. It would be taking at least 2 years, if not 3 years, before we can look at 3%. So I think the starting point of the budget would be that how do I get it from 8% to maybe 5% or 6% in the in the next financial year, and then gradually go back towards the region of 3%. Given this being one of the primary goals of the fiscal management in this particular budget, uh, we would tend to believe that given the fact that you cannot really lower the taxes, all of us would like to have lower taxes. The corporate sector would like to have lower taxes. We as individuals would like to have lower taxes. And I think a supply side economics tend to say that if you lower the tax rates, it will lead to higher consumption, higher investment. But fortunately, I don't think the government is in a position to actually cut rates because we're not quite sure what's going to be the growth taking place in the next year. Because we have calculated that even in case there's an abnormal 15% growth in nominal GDP next year, that is 10% growth in real GDP, 5% growth in inflation, we would still about be reaching the GDP nominal number of 224 to 25 crores, which was what was assumed for 2021, which really means that we're not going to garner that kind of tax revenue based on what tax rates we have. And I think there are lots of uncertainties in terms of whether this investment, which has been used more as kind of a balancing item, whether it would really be able to, you will be able to really complete this particular program. So there are going to be problems on the revenue side. So therefore, we would tend to believe that expenditures are not going to be very extravagant. Focus will, of course, be to begin with on how do you make sure that this vaccination drive goes on, whether we will be able to vaccinate a larger number of people, because a larger number of people means a higher cost to the government. So even if you're talking in terms of, say, something like 400 rupees per vaccinated person, if we just multiply it by a population of 1,300 million, that would be coming to something like 50,000 crores. It's on a very much lower side. So I don't think the government is willing or has the ability to spend 50,000 crores in this particular year. So it's going to be spread out, maybe spread over what the center does, what the state does, and what we will be opening up, what we'll be throwing open to the private market so that we go and pay for our own vaccination. So all these kind of possibilities are, of course, there. So given that concentration more on health, probably on education, because I think education has taken a new kind of form. So even in terms of public education, that is what is being sponsored by the government, things are turning to the online mode. So there will be larger investments made by the government in terms of making sure that the infrastructure is created. I think on capital expenditure, I would say that we should temper our expectations. Last year, we saw that something like 4.1 lakh crores was budgeted for capex. Another 25,000, 30,000 crores was announced during the course of the year. And again, out of this 4 lakh crores, around one third of it normally typically goes for defense. And defense may not really be adding to demand within the country. A large part of that could be imported arms and ammunition, which we have. So talking of 4.3, 4.4 lakh crores, probably the maximum we could be thinking of is an increase of around 5 to 10% in the current financial year. And there too, I think most of the concentration is going to be on roads and railways. That's what we have seen in the past, and maybe to a certain extent on urban development. So with all these constraints, I would look at the budget more as kind of a balancing act this year. So even though the FM said that there are going to be lots of positive moves, but I think if you really look through it, see what kind of measures have to be taken for relief, for education, for health, I don't think there's going to be too much of room to really think of great deal of expenditure on the capex front. At the same time, there will have to be something done in terms of capitalization of public sector banks. There's talk of setting up of a new DFI for which there'll have to be contribution coming from the central government. So I think there are going to be multiple objectives of the government, and trying to satisfy all of them will not mean to deployment of too many resources to it. So therefore, I would say that we could be happy in case we are talking of a fiscal deficit in the region of around 5 to 6% for next financial year, maybe 5 to 10% increase in capital expenditure. Hopefully not any major tax burden being imposed on the people, because there's some talk of a COVID tax, a COVID cess, which could be imposed by the government. And we have seen in India that once you have a cess, it remains forever. It never really goes. And that could be, of course, quite negative for consumption, especially if you're going to tax it on the non-lower income groups, because look at the consumption, it typically emanates from people who have the spending power. You're going to tax them, it could be counterproductive. Now, against this background, the last part would be on terms of monetary policy. I think there's some good news which came a couple of days back when the CPI inflation number came much lower than what we expected. Because if you look at the RBI's projections of inflation for the fourth quarter, it continued to be in the region of around 5 to 6%. Now we're talking of something in the region of 4.5%. So while in this particular policy, we may not expect the Reserve Bank of India to take any rate action as such, but the doors definitely do open for rate cuts during calendar 2021. And probably the policy of April could be looking in terms of a rate cut, provided inflation remains benign. Of course, what we have seen in inflation is that normally when the food items prices come down, there's a tendency for non-food prices to increase. And that's something which we've again noticed out here. And the fact that we've had the winter months, which typically sees food prices coming down, is what is manifested in the inflation numbers of 4.6% inflation, which we saw, which was released on last week. This may not really last continuously. I think the RBI is also aware of the fact that food prices do, especially of vegetables, cereals, they tend to increase once we move towards the summer season, which would be April, May. So I think there would be a wait and watch policy followed in the month of February. That is the policy which comes just after the budget. And, but there's definitely hope that there could be some rate action. Otherwise, we were really penciling in the fact that there may be no rate cut at all in the year 2021, going by projections which the RBI made earlier for inflation. And the fact that any revival in the economy would also mean that demand pull inflationary forces would be picking up. And just to point out here, I think we had the WPI inflation numbers which came yesterday. For the first time, we saw that the prices of manufactured goods had shown inflation of around 4%. And that's happened after a very, very long time. It's a positive sign from the point of view of industry, because it actually shows that there is some bit of regaining of the pricing power, which was lost for a very long time. But again, we need to see whether this can be sustained, whether this really translates into further higher inflation, which could come in the way of monetary policy. So I think as of now, we'll have to have a wait and watch policy, a patient look as far as the budget is concerned, and a wait and watch when it comes to monetary policy. We definitely do expect the economy to fare statistically better than what it did in 2021. But of course, that's a no-brainer, because if I'm talking of a negative growth rate in 2021, 21-22 would definitely tend to throw up a much higher rate, positive rate. Right now, we're looking at something closer towards the 10% mark. And the important thing, of course, even while interpreting these numbers, because I think you all must have read about lots of forecasts which have been put out by different agencies, which are talking of things ranging from 8% to 14% growth next year. But I think the critical thing which we should always look out for is that our jobs being created. Because unless jobs are created, income increases, only then will we be able to revive the consumption cycle. And only when the consumption cycle recovers, would there be an incentive for more investment to come through. And when we have the investment growing, investment rate, in fact, has been coming down to something like 26.5%. But we need this number to go back towards the 34% mark, which we had seen at the time when the Indian economy grew by around 8%. So I think that's what we should really watch out for: jobs being created, consumption going up, leading to higher investment. I think that's when we really know that the economy is in a stronger position. So I would tend to believe that 21-22 will be a year of consolidation. Hopefully, the vaccination and its negative impacts should be behind us by the time we come to the end of this calendar year. And from 22-23 onwards, we could really talk of a genuine growth taking place, probably in the region of around 6.5-7% to begin with, before we go towards the 7 to 8% range. That's how we will be able to reach that 5 trillion economy mark. Thank you.